We've got the MD and CEO of Canfin Homes joining in to talk about their numbers. Let's welcome on board then Girish Kousgi. Girish, hi, good morning. Good to have you on the show. Your provisions in the quarter gone by were down about 65% sequentially. Where are you in terms of your provisioning now? Do you expect these levels to go down further?
Good morning. So in terms of provisioning for COVID, we have provided close to 86 crores, which is more than required. In terms of overall, it's 214 crores. If you out of that, the breakup is 86 for COVID and about 55 crores for ATP, and the rest is standard provisioning. So overall, we hold about 214, including 74 of standard asset provisioning. So we are very much covered for any possible NPAs, in future because of COVID.
Okay. How is it that you're analyzing the demand scenario right now, Girish? Where is the growth largely coming in from? If you could share your outlook for the second half of the fiscal.
If you look at Q1, we did business only for 5 weeks. We lost whole of April and first 3 weeks of May. And if you look at Q2, we did business slightly more than double of what we did in Q1. So with every passing month, the demand is slowly improving and demand is slowly coming back. At the current level, we are back to about 70% of our peak levels. So if you compare H2 of last year and H2 of this year H2 will be definitely good, but we will not match up with H2 of last year. We might get probably close to 80% of last year H2. If you compare with H1 of this year, H2 would be definitely better, significantly better. So we feel that in Q4 is where the overall demand would be back to about 80 to 85%. And it will take another quarter or two, that is Q1 of next year or Q2 of next year, for the entire demand to come back. I'm talking about affordable space, not non-affordable, because we largely operate in affordable and 99.99% of our funding is to retail investors.
All right. I want to also touch upon your overall disbursements. That has improved on a sequential basis. How far are you now from your pre-COVID levels when it comes to disbursements, and when do you see things normalizing on this front?
So as I mentioned, we are currently at about 70% of peak levels. So in Q4, we would have reached to a level of about 85%. So there'll be a gap of 15% from the peak level, which we feel can happen in Q1 of next year. And also because it is demand is definitely coming back. It is definitely improving, but it will take some more time for complete demand to come back, which we feel will happen in Q1 or maybe Q2. For us, we would have reached about 85% of peak level in Q4. Also now, I think lot of focus is on asset quality. And therefore, we have to balance both. And now more so in terms of managing the book, managing our customers who have opted for moratorium, and very shortly we will have restructuring coming in. So I think a lot of efforts and focus would be on managing our customers, trying to make their dealings with us more convenient. And of course, wherever there is opportunity, we'll try and do business.
Yeah, and speaking of moratorium, now that it's ended, your asset quality as well, if we look at the trends, has seen a slight improvement. So how much stress are you expecting now to reflect on your books now that the moratorium has ended in the upcoming quarters? If you could just share with us the outlook on your NPA trends.
See, now morat is over, because after morat, we've seen one full month. Actually, if you take October, at least you would have seen 1.5 months, which means it covers almost about 70% of the cycles in October. So if you look at September, our collection is about 93%, which is actually better than pre-COVID levels. We have the lowest bounce rate in the industry, and if you look at September, our collection is 93%. So now morat is out, because after morat, customers came back and they've paid. With whatever bounce rate we had a 20% spike in bounce rate compared to pre-COVID levels, and the overall collection in September was 93%. So now I think the challenge is going to be in terms of stabilizing the Murad book for next couple of quarters and trying to help customers who needs restructuring. So in terms of asset quality, there has been a drop in gross NPA from 0.75 to 0.72%, and there was a Supreme Court order. There was a direction that no company should tag as NPA. So if I have to include the deemed NPA, the NPA would have gone up by 6 bips. It would have been 0.78 against 0.72. So we are pretty much controlled as far as asset quality is concerned.
Okay. Where do you see FY21 ending as well in terms of AUM growth? Like, what's the strategy for FY21-22, let's say, on that front?
See, we have a very strong retention team. What has happened during COVID is that since opportunity in the market was quite low in Q1, even though it's improving month on month from June onwards, still it's not back to 100% pre-COVID levels, and therefore there has been heightened activity as far as the takeovers are concerned. So we have a strategy in place to offer competitive rates both for new customers while onboarding and for existing customers. So customer retention is a very key strategy for us, and we are trying to look at that very, very closely. If you look at, we've grown the book by 10%, so which used to be about 15% otherwise. So you will see at the same level in terms of AUM growth, maybe it may improve by 1% or 2%. This would remain for next 2 or 3 quarters because of demand not being completely back. At the same time, of course, there is a differential pricing which each set of institutions offer. So it's a strategy. We have to balance between BT in and BT out. And that is something which we've been managing for last so many decades. We will also manage in next few decades. So yes, because the demand is down, growth would be slightly low for next 2 quarters. Because growth is low, even the book growth would be in the range of about 10-11%.
Okay. NIMs also expanded by 19 bips and borrowing costs have eased, of course, on ample liquidity. So is there a case for further margin expansion?
Not at all. No, this NIM is NIM of 4.09% is not sustainable because what happened was in last few quarters rates dropped drastically. Now, if you look at next 3 to 4 quarters, the rates may not drop substantially. Yeah, it could be 5 bips or 10 bips. So the scope to improve COF is going to be limited. And therefore, we'll not be able to maintain this NIM. We will be happy if NIM is more than 3%. Today it is 4.09. Today our spread is 2.86%. We'll be happy if it is upwards of 2.4. So current NIM and spread is not sustainable. However, we will maintain a healthy NIM and spread, which is more than 3% NIM and 2.4% spread. On liquidity, we are pretty well covered. We are covered for next 12 months. We are excess on liquidity. Being excess on liquidity has actually helped us to be very competitive in the market and offer fine rates to customers and onboard more customers in this difficult time. So we'll continue with that strategy in future as well.
All right. Thanks so much for joining us this morning, Mr. Kousgi, and talking us through that, Mr. Kousgi, and sharing with us the details at Canfin Homes. That's Girish Kousgi, the MD and CEO of Canfin Homes, taking us through all of the factors at play right now. We're going to take a very quick break. Back in just a moment.